Why use commodity ETFs for an economic growth outlook? Imagine a world where your investments can grow alongside the economy, capturing the rise of raw materials and resources. That's where commodity exchange-traded funds come into play. These funds track the prices of raw materials like gold, oil, agricultural products, and metals. They let you invest in commodities without needing to buy physical assets or store them. Instead, you buy shares on the stock exchange, just like buying a stock. When the economy expands, demand for raw materials usually increases. Factories produce more goods, construction ramps up, and consumers spend more. This increased activity often pushes up commodity prices. For example, during periods of global growth, prices for industrial metals like copper and aluminum tend to climb because they are essential for manufacturing and infrastructure projects. Investing in commodity exchange-traded funds during these times can help you benefit from this rising demand. Another reason to consider commodity exchange-traded funds in an economic growth outlook is their ability to act as a hedge against inflation. As economies grow, prices for goods and services tend to rise. This inflation can reduce the value of cash and bonds. Commodities, especially those used in industry or held as stores of value like gold, often increase in price during inflationary periods. Gold has long been seen as a safe haven asset, especially when economic uncertainty or inflation is high. Oil and agricultural products also tend to respond to economic trends, helping investors protect their purchasing power. Diversification is a key benefit of commodity exchange-traded funds. Their prices often move independently of stocks and bonds. Adding these funds to your portfolio can reduce overall risk. When traditional investments struggle during certain economic phases, commodities might perform well because of rising demand. This balance can help smooth out your investment returns over time. Commodity exchange-traded funds come in different forms. Some hold physical commodities like gold bars stored in vaults. Others use futures contracts, which are agreements to buy or sell a commodity at a future date, to track prices. There are also funds that invest in companies involved in producing commodities, such as mining or energy firms. Each type has its own risks and rewards, so it's important to choose based on your investment goals and risk comfort. Trading these funds is straightforward because they are bought and sold on stock exchanges during market hours. They usually have lower fees compared to actively managed funds, making them cost-effective. Their transparent pricing allows you to see how your investment is performing in real time. However, it's important to remember that commodity prices can be very volatile. Geopolitical events, weather conditions, and supply chain disruptions can cause sudden price swings. Futures-based exchange-traded funds may not always track spot prices perfectly because of market factors like contango and backwardation. Also, most commodity exchange-traded funds do not pay dividends. Your returns come solely from price changes. Using commodity exchange-traded funds as part of your investment plan can be a smart move if you expect economic growth. They give you exposure to sectors that benefit from expansion, help protect against inflation, and diversify your overall portfolio. Picking the right funds and understanding their risks can help you make the most of these tools in a growth environment. For example, if you believe infrastructure spending will increase, investing in an industrial metals fund could be a good choice. Or, if you want a safe haven during uncertain times, a gold ETF might be your go-to. Overall, commodity exchange-traded funds are practical, flexible, and can help you stay aligned with economic trends.